All right, let's jump right in. Today, we're tackling one of the most crucial skills for any auditor: evaluating audit results. This is where the real magic happens, you know? It's how we take a small sample of data and use it to make a big conclusion about the entire set of financial statements. It's a mix of hard science and professional gut feeling, and we're going to break it all down using Chapter 8 of the Financial Audit Manual.
So here's our game plan. First, we'll get into the core challenge. How do you even begin to project from a tiny sample to a massive population? Then we'll open up the auditor's special toolkit. After that, we'll put those tools to the test in a real-world case study, see how to combine all the results for the big picture, and finally, figure out what on earth you do when the numbers just don't look right.
Okay, let's get into it. The heart of most audits really comes down to sampling. I mean, it's just not possible to check every single transaction, right? So we test a representative chunk. But that creates this huge dilemma. How confident can you really be about the mountain of stuff you didn't see?
I want you to really think about this for a second. You check 181 invoices out of 30,000 and you find 4,000 rupees in errors. So what? What does that tell you about the other 29,819 invoices you didn't even touch? You can't just ignore it, but you also can't just assume those are the only errors. Figuring this out requires a systematic, almost scientific approach, because if you get it wrong, you could make a massive mistake.
Now, to solve this problem, auditors don't just, guess. They use a pretty sophisticated toolkit with three key concepts: known error, most likely error, and the upper error limit. Let's unpack each of these.
First up is the known error, or KE. Honestly, this is the easy part. It's just the grand total of every single error you physically found and documented in your sample. So in our example, that's the 4,000 rupees. It's your factual starting point. Think of it as the very tip of the iceberg.
Next up, we've got the most likely error, or MLE. This is where the projection really starts. Based on the errors you found in that small sample, you make a statistical estimate of the total error you'd probably find if you had time to check the whole thing. It's your single best guess for what the true total error is.
And finally, we have the most critical one of all, the upper error limit, or UEL. Look, because we're only working with a sample, there's always a risk that the actual error is higher than our best guess. The UEL is what accounts for this risk. It sets a ceiling, basically saying we are 95% confident that the total error in this population is not more than this amount. It's the auditor's essential safety margin. So you see how these ideas build on each other, right? You start with your hard fact, the known error. Then you project that out to get your best guess, the most likely error. But because you can't be 100% sure, you add a statistical buffer for that sampling risk. This buffer is made up of a couple of things the FAM calls basic precision and precision gap widening. We'll see them in action in just a minute, but when you put it all together, they get you to your final, super conservative conclusion, the upper error limit.
Okay, theory's great and all, but let's see how this actually works in the real world. We're going to walk through a case study from the Financial Audit Manual that deals with an audit of production expenditures.
So here's the setup. Auditors are digging into the production spending of a power plant. As they're going through their samples, they find that some of these expenses have been overstated. So now they have a problem. Is this just a small oopsie, or is it a material issue that could mislead someone reading the financial statements?
And this table right here shows us exactly how they got to their answer. They started with the most likely error for the overstatements, which they calculated to be about 1.5 million rupees. Then they add their safety margin. It's got two parts. First is basic precision. That's kind of like a baseline buffer for risk, the error that could be hiding even if you found nothing. The second part is precision gap widening, which is an extra buffer that gets bigger the more errors you find. You add all that up and you get to the final, crucial number, a net upper error limit for overstatements of 3,584,850 rupees.
Okay, here it is, the moment of truth. The auditor takes this upper error limit and compares it to the materiality threshold they set way back in the planning phase. Remember, materiality is the size of an error that would actually make a difference to someone's decisions. In this case, that line in the sand was 3 million rupees.
And here's the bottom line. Their maximum possible error, the UEL, is over 500,000 rupees higher than their acceptable limit. That's a huge red flag. According to the Financial Audit Manual, this is a flat-out unacceptable result. The auditor simply cannot conclude that this part of the financials is clean.
But remember, an audit isn't just about one line item. Auditors have to combine the results from all the different areas they test, revenue, assets, other expenses, to see the whole picture and form an opinion on the financial statements as a whole.
And the FAM has some very specific and frankly, very conservative rules for doing this. You can net out your best guesses, the MLEs, but you are not allowed to do that for your safety margins. For basic precision, you have to use the biggest single amount from any one component. And for precision gap widening, you have to add them all up. The reason for this is absolutely critical, which brings us to our next point.
And here is exactly why that caution is so important. This quote from the manual says it all. If you just netted everything together without looking at the individual pieces first, a huge material overstatement in one area, like our production costs, could get canceled out by an understatement somewhere else. You'd end up with a final number that looks perfectly fine, but you would have completely missed a massive problem hiding in plain sight.
So, you've done the math, and you found an unacceptable result. What now? You can't just pack up and go home. The FAM lays out a very clear set of options for what an auditor has to do next.
For all you candidates watching, listen up, because this is a classic scenario, both for exams and in the real world. Your best guess of the error, the MLE, is under the materiality line, which is great, but your safety margin, the UEL, goes over that line. What do? The FAM gives you 4 distinct paths you can take.
And here they are. First, you could try to increase the materiality amount, but that's really rare and you'd need a rock-solid reason. Second, you could increase your sample size, hoping to shrink that UEL. Third, you can ask management to just fix the problem by recording a correcting entry. Or fourth, you can ask them to do a deep dive into the whole population to find the exact error amount.
But here's a super important piece of practical wisdom from the manual. You might think, oh, I'll just expand the sample. That's the easy fix. But the FAM warns you to be careful. In our case study, the UEL was almost 34% higher than materiality. Trying to bring that number down just by sampling more would probably require a ridiculous, totally impractical amount of extra work. In cases like that, options 3 and 4, asking for a correction or an investigation, are usually the only real ways forward.
So for all the PPFA and DAO candidates out there, I really hope this deep dive into FAM Chapter 8 helped clear things up. This decision process is absolutely key. If you found this useful, definitely subscribe for more. And hey, if you have any questions about KE, MLE, or UEL, drop them in the comments below. Let's talk about it.
And before you go, I want to leave you with one last thing to think about. We saw that one of those options was to just increase the materiality amount. So consider this. What kind of ethical mess do you find yourself in if management, who is desperate for a clean audit report, starts pressuring you to just pick that option, instead of actually investigating and correcting the errors? It's a question that takes this whole technical process straight into the heart of what it means to be an auditor with integrity. Thanks for watching.